Hello there. Welcome to the Open on BNN Bloomberg, where the action is. Markets open in about half an hour. TSX closed at another record high yesterday. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Fourth quarter profit for Loblaw came in slightly above estimates, but revenue missed expectations. Both food retail and pharmacy same-store sales were up. However, December sales saw a brief bump due to a holiday season in Canada. Results come as high inflation and a rising cost of living have led consumers to try and tighten household budgets and save money. National Bank of Canada beat profit estimates in the first quarter with strong results across the board. Personal and commercial banking income grew by almost 50% from a year earlier, with the bank's acquisition of Canadian Western Bank contributing double-digit gains. The Montreal-based lender also plans to return more capital to shareholders by buying back more shares than earlier planned. Tamarack Valley saw a 29% drop in fourth quarter profit year over year. That was owing to lower oil and natural gas sales. The company has completed a multi-year transformation into a core Clearwater and Charlie Lake producer. It also beat analyst estimates for fourth quarter production. The U.S. futures, you can see, are pointing up, and that's after yesterday's rally in tech stocks from Monday's sell-off. And, of course, the world, investors around the world standing by for the NVIDIA numbers later today. TSX closed at yet another record high yesterday. Of course, gold prices have been once again fueling the market's rise this year. And let's have a look at oil, because it's been trading near the highest since last summer. That's because U.S. President Donald Trump is not ruling out an attack in the near term on Iran. And let's check out gold, which has been such a winner for investors this year. Once again higher amid tariff uncertainty. The U.S. once again warning trade partners, you got to stick to deals that you already agree to, even as President Trump revises his tariff policies. And let's have a look at the Canadian dollar. And you can see under a little pressure today and slipping below the 73-cent level. And finally, Bitcoin. Let's have a look at where it's trading. And it's rallying a bit today, up around 4%. BMO and National Bank posting first quarter results with both lenders topping expectations. Let's get insight into the numbers. We're joined by Paul Harris, Portfolio Manager at Harris Douglas Asset Management. Paul, start off with BMO, if you would. There have been concerns about the strength of their U.S. operations over the past few years, in particular credit quality. Did anything jump out for you with the numbers?
Well, I think it's always going to be, the U.S. is a very difficult environment to work in. You saw that with TD even, where you don't they've always had these kind of expectations of higher ROEs and they can't seem to meet them. I think the BMO is sort of working through that process. It's going to take a while, but you saw that they got actually a decent ROE on their business. They're looking at trying to get it up to 15%. They need to have better, loan loss provisions have to get better there, and also maybe some better growth on the loan side. So I think they're working on it. I just think it's a work in progress. It's a very hard environment to I think, be a retail bank in or a bank in the United States, because it's so much more competition there.
You think, you mean in the United States, far more competition?
Yeah, particularly, yeah. Right.
Yeah, it's interesting. I wonder about in Canada. Obviously, we do have these dominant 5 or 6 lenders, but the likes of EQB are growing pretty quickly.
Yeah, so I think obviously there's these other people that compete with the traditional banks in Canada, right? But I think that they in many ways, it's hard for them to compete at a level because banking is a scale business, is a huge technology business, and so having a large scale makes a big difference. And and I think that makes a difference to many other things that the bank can do, whether it's like capital markets, for example. It's a really being a large player in capital markets requires you to be very large, I think, to compete with in the United States or compete in Europe or even in Canada. So it's a difficult environment for these smaller institutions, and they can be niche players. But it's very hard to be the broad spectrum that many Canadian banks offer, I think.
Are National or BMO stocks that you would buy with new money right now, Paul?
Well, we own the BMO. I think that we would continue to own it. I think what you have to look at when you look at these numbers, I think the credit quality, when you look at credit, which is something that's very important, I think it's pretty much in a holding pattern. I think you see those numbers come down. I think the big difference is going to be for many of these companies over the next several quarters is the capital markets side, right? So I think the capital market side will continue to do well. We have a bull market in resources in this country. So I think there's going to be a lot of good capital market revenue, and it's a high ROE business. I think one of the issues that all these places are facing is a sort of lackluster loan growth, right? And you saw that with the BMO numbers as well. So I think that's the issue. And for them to kind of meet their return on equity numbers, they're going to have better loan growth. And I think the other issue the banks face in Canada, I mean, they're only up about 2% in the so far this year, relative underperforming the TSX. But I think you need EPS momentum, and I don't think you're going to. It's going to be harder for them to see that because in 2005, going into 2025, rather, people had about a 6% revenue growth. This year, they have a 10% revenue growth. So the bar is raised so much higher for these banks to meet. And so I think that's the bigger issue for whether banks are going to outperform the TSX or not, or even meet the TSX returns, is that they have a much higher bar to meet from the street consensus, right? But I think there are a lot of little variables that are going to help them, saying, for example, capital markets. And the other thing that's really going to help them, I think, is that they have a lot of capital. It's one of the,
Did we lose Paul there? Sorry, we lost Paul there. We'll try and bring him back. Paul Harris, the audio cutting out there. There's National Bank over the past year, up 43%. Let's have a quick look at Royal Bank, always the bellwether for the sector because of its giant size. See, National Bank has outpaced Royal Bank, but just about all the major Canadian banks trading at or near record highs right now. Let's have a quick look at Loblaw over the past year because Loblaw has been trading close to record highs and just announced that $2 billion plus expansion in Canada this year. Revenue slightly missing expectations, but profit strong, and same-store sales up, crucially in pharmacy and regular grocery. That massive acquisition of Shoppers Drug Mart so far seems, it's quite a few years old now, has produced a tide of profit for Loblaws. And let's have a look at BMO over the past year as well. BMO certainly the headline number beating expectations on profit, and that stock near record highs, up 36% in the past year. One stock we are watching is Thomson Reuters. Maybe we can put up a one-year chart for Thomson Reuters because we're hoping to speak to the CEO of that company later on. Now, there is Thomson Reuters. Wow, the rally in the stock yesterday it just looks like a rounding error on that one-year chart. But we are hoping to hear from Steve Hasker, CEO and president of Thomson Reuters, at 9:40. Okay, we got lots more coming up on the open. Excuse me. Conditions in Mexico seem to have calmed down after deadly cartel violence near Puerto Vallarta had tourists and others hunkering in place. The country is trying to project a sense of being back to normal despite a beefed up military presence. Global Affairs Canada is still advising Canadians to use a high degree of caution and take it day by day. CTV's Avery Haynes filed this report.
I want to show you the destruction that was left by the Jalisco cartel rampage on Sunday. This used to be a convenience store. If you look way back in there, there's still beer in the cooler. OXXO's kind of like 7-Eleven, and more than 100 of them were hit across this region. Here's how they did it. They take bags of gasoline, throw it inside, leave a trail of gas, and then set it on fire. Just down the street, the parking lot is a graveyard of burnt cars now being cleaned up. The big news for Canadians who have been stranded here since Sunday is that the airport is open again. Long lineups as travelers are about to end a vacation they will never forget.
It's been harrowing. You're having such a great time, and all of a sudden, without any warning, this happens and you're in a shock.
Were you scared?
A little bit, because I have my daughter with me. And
These are not sunsets and beach photos. Oh my Lord.
oh yeah, there it is.
It'll be a good story to tell. I mean, we're just happy that we're safe.
If you have to be confined, sheltering in place in a resort on a beach with a pool and an open bar, you know, it could be worse. But yeah, glad to be going home though. And it's a real shame because it's a lovely place. The people are wonderful. And this is going to be a black eye.
55,000 Canadians are registered with Global Affairs as being in Mexico. That number is getting a little smaller now that the planes are taking off again. But there's frustration at the airport, too, because some Canadians say they can't book another flight. Avery Haynes, CTV News, Puerto Vallarta.
The Open will be right back. Ottawa summons staff from OpenAI over the company's safety protocols. This comes after revelations that the AI provider didn't immediately notify police about troubling interactions the shooter in Tumbler Ridge, BC had with ChatGPT. CTV senior correspondent Judy Trin has more in this report.
Mr. Park. This is OpenAI's top official, responsible for safety. Chan Park was asked repeatedly if he had a message for Canadians about Tumbler Ridge. He said little.
We are very much looking forward to talking to the ministers and talking to the government.
What do you have to say to the victims of Tumbler Ridge? 7 months before the killing spree, a ChatGPT account linked to shooter Jesse Van Rutselaar was flagged internally for abuse and enforcement. The U.S. tech giant did not notify Canadian police until after the rampage. The AI minister wants to know why.
Tell us more details about their safety protocols, their escalation thresholds, and how they keep Canadians safe.
In a statement, the company said it did not alert police because the case did not meet its threshold, because OpenAI did not identify credible or imminent planning.
It looks like OpenAI had the opportunity to prevent this tragedy, to prevent this horrific loss of life.
Van Rutselaar killed 8 people. 6 of the victims were children. Her boss stayed silent, but an unidentified spokesperson says the company is cooperating with the investigation.
We're going to give a briefing to the ministers. We've been fully transparent with law enforcement here in Canada.
For AI experts, the killer's use of ChatGPT reinforces the need for strong legislation to rein in the technology.
They are barreling forward with the deployment of new tools and features and technologies without properly considering the broader safety implications of their products. And until we force them to do so, that will continue to be the trend.
Concerns about OpenAI's safety protocols is coming at a time when the American tech giant is actively lobbying to help the Canadian government create a sovereign artificial intelligence platform.
As of today, Canadians visiting Britain need to apply for an electronic travel authorization before they board their flight. And Canadians who are dual British or Irish citizens risk being denied entry if travelling with a Canadian passport. For more, we're joined by CTV's Scott Hurst. Scott, just describe these changes, please.
Good morning, Andrew. It is a digital permission document that is needed as of today, the Electronic Travel Authorization, also known as ETA, and it is required for visitors from 85 different nationalities, including Canada. The program initially launched in late 2023, but the UK government in November of last year announced it would begin widely enforcing the travel requirement as of February, meaning no travel to the UK without advance permission. The government says the ETA will help digitize the immigration system, provide a more seamless travel experience, and ultimately give authorities greater power and control over who's allowed in. So now enforcing the requirement will mean that everyone must have digital permission to enter the country, or else they could be turned away. Now, applying for an ETA isn't a huge cost, about £16 or roughly about $30 Canadian, but you have to go through the official UK ETA app, Andrew, in order to apply.
Gosh, more bureaucracy. That's what we need. Scott, I think we're going to have to jump. Thank you very much indeed.
Thanks, Andrew.
Okay, coming up, Desjardins is out with its financial results. We'll look at those numbers when we come back. Welcome back. Desjardins just released its financial results for fiscal 25, and we sat down with Denis Dubois, CEO of Desjardins Group.
As you look at the overall growth being at 11.2%, when we look at the revenues, I think we've shown last year our ability in a challenging context with a lot of uncertainty to be able to answer the needs of our members and clients throughout the country. So as we look forward in 2026, we see a context that will be along the same line. So we think we are well positioned to achieve similar growth as we look at 2026.
Got it. So Desjardins increasing contributions to community development, including the Good Spark Fund, housing initiatives, to name a few. How do you pick and choose which projects or regions receive that funding?
So what we do is we do have within our co-op-based credit unions that are located at the local level. And so they are the one that do select our board members. We have roughly 200 credit unions that are part of the group. So the board members of those credit union, Caisse Populaire, they are the one that will select, based on the needs of the local communities, the different needs. And we're very proud of having last year alone put back in the communities $133 million in sponsorship donation. We also have Desjardins Foundation that is highly engaged. And at the group level, we also look at other causes where we believe, for example, within the property and casualty insurance sector or the life and health insurance sector, for a specific cause that do support what we're trying to achieve in those different businesses.
What metrics do you use to measure the social impact of this?
So we do have our own survey that we do every year to measure the impact of what we do in the community, just to make sure that those actions are well perceived, I would say, within the community. So, and we have obviously also the privilege of having 2,200 board members within those guys, plus our employees and general manager that are spread out throughout the country. And we have 4 times a year a meeting with 500 of those people where we do also take their feedback on how things are going in the field. So we have different measures that we use just to make sure that those investments back in the communities do create the right impact at the end of the day.
Also, right now, obviously, in response to the housing crisis that Canada finds itself in, Desjardins is stepping up its commitment. The goal is to create more than 10,000 housing units by 2028. That's quite an ambitious goal. So how do you scale partnerships and financing to try to reach that within that timeline?
So we started our initiative back in 2022, and it took a few years to get our approach developed, and so with obviously the provincial and federal governments, with also different partners, cities at the local level, having those people working together, and we really saw traction with the team that was created, their network, the approach in 2025, and we're very pleased at the end of 2025 to already have either built or in the process of being built 5,000 of those housing apartment being underway, and with what's already worked on. Honestly, we feel very positive that we can have an impact or get to that target of 10,000 by 2028. And a lot of it was done in Quebec, and today we're looking to expand what was done in other provinces, including Ontario.
Okay, just the one last thing we can get to here is the launch of Cyber Suite Plus for small and medium enterprises. Can you tell us a little bit more about what that is and kind of what that entails?
Yeah, so we do have a property and casualty insurance product within our organization. So, and we do offer commercial insurance. So obviously those small companies do feel the pain of going to a cyber attack. And so we wanted to make sure that we have a product to provide the right support if they do feel the pain of a cyber attack. So this was an updated and refreshed product that was launched. And obviously that is very relevant to those small and medium companies today.
Obviously, digital protection is important, but how do you balance that with the need of cost pressures that many small businesses are facing?
So, in fact, we've been, as an organization at Desjardins, being so committed to develop digital protection for first the organization and at the same time for our members and clients. So we do have within the group what is called the Desjardins Protection that do provide different tools to our members and clients to avoid getting into the situation of being either hack or fraud. So that provide, for example, alerts. There's also, if there's a theft, identity theft protection that is provided. So we do have those tools that have been developed and that they are evolving over time just to make sure that we provide those tools to our members and clients to avoid those situations. But at the same time, that risk do occur, and so make sure insurance is there if they're not able to protect themselves.
Let's take a look at U.S. futures as we count down to the opening bells. Looks like we are going to get a positive open on Wall Street, but of course the threat of AI disrupting the tech industry hanging over the market. And also, interestingly, there are questions about how internet companies are financing this massive capital spending on data centers. Veritas coming out with a report saying that some of this spending is being shuffled off into obscure off-balance sheet entities, for example, Meta doing that. And one of the ideas there would be to keep debt off the balance sheet and also to stop besmirching your return on equity numbers. And so when you hear about stuff being shoveled off into financing vehicles, you always say that has to sound warning bells because those things are more opaque. We've got those opening bells coming your way next. Let's get to the opening bells. There you have it, the opening bells on Bay Street and Wall Street. At the NASDAQ, it's Intap. At the New York Stock Exchange, it's Americares. And at the TSX, it's Perseverance Metals. Opening the market, it's time for the first 15. And let's check in on the equity markets as we get going on this Wednesday morning. We will start off with the TSX pushing further. And breaking 34,000 for the first time. TSX pushing further into record highs, helped by oil prices. Oil has been trading near the highest since last summer. We did see, for example, WTI getting to its highest since August. And that's partly as the U.S. positions military forces in the Middle East. They're trying to twist the Iranian arm getting them to agree to an end to their nuclear and ballistic missile program. But there's speculation that the Americans will launch some kind of attack. And you can see S&P stocks also higher. Let's get to some stocks of interest here. BMO. BMO shares higher, jumping 4% in early trading. Investors happy with the numbers in the latest quarter. Cash EPS coming in 15%, up 15% year over year, 348. And that's about, wow, that's interesting, about 28 cents above the street. Apparently, according to Canaccord, better capital markets and a reduction in provisions for credit losses fuel profit growth. And let's have a look at National Bank. That stock up almost 50% in the past year, jumping 4% today. Jeffrey saying the numbers were impressive, coming in well ahead of expectations. Strong capital markets, but there was also decent results in domestic banking and wealth management. And the company is increasing its forecast for return on equity. And it's also pressing ahead with stock repurchases. And then finally, let's have a look at Loblaws, the gigantic grocer. That stock's slipping in early trading, down around 3%, but it's had a great gallop over the past year. Now, profit topping expectations by only a cent. However, Desjardins, which has a buy on the stock, says expense control was good, but it was partially offset by lower than expected gross profit due to slightly lower than expected retail revenue when you exclude the contribution from PC Services, which is their mobile phone operation. But same-store sales growth steadily improving through the quarter. And in pharmacy, it was almost 6% growth year over year, although apparently that was slightly below consensus. So investors not jubilant over the Loblaw results today. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeffrey, great to see you. Axon, tell us what's happening. They are seen as an AI winner.
Apparently so. This is a company that is behind tasers and also some public security software. So perhaps an unexpected AI winner. The stock is up. It's one of the top performing stocks in the S&P 500 so far this morning, up as much as 11% in the pre-market session. Worth watching over the course of the trading day to see what happens here. Analysts on Wall Street largely fairly jubilant about the results that this company reported, including a pretty sharp rise in AI bookings. So some of its software and some of its programs can offer or I guess work with serve the AI sector, and those have risen sharply to about 10%. Piper Sandler sees this market being supercharged for Axon, and as a result, the stock is getting a big lift so far this morning. So Wall Street largely positive, and this is the top performing stock in the S&P 500 so far.
And GoDaddy down, revenue forecast disappointing the street.
That's right. This might be one of the AI losers, and this was one of the worst performing stocks in the S&P 500 so far today. Down sharply, down 17% pre-market. Wall Street largely panning these results. This company got price target cuts at Morgan Stanley, UBS, JP Morgan, RBC, Cantor Fitzgerald, and B. Riley, among others. Really big drop so far, 17% right now. Revenue disappointed, the first quarter and full year earnings outlook disappointed. And yes, this is a company that, of course, people use to register websites online. Perhaps some of that can be done by AI. The company is not reporting enough growth in what it is considered its own AI segment, and the results this morning and the reaction to the results are quite negative almost across the board here.
Jeff, thanks very much indeed. Jeff Morgan of Bloomberg. Coming up, U.S. President Donald Trump, as you might expect, lauded the impact of tariffs in his State of the Union address. But what effect will it have on the markets? We'll get perspective after this. U.S. President Donald Trump spoke for a record hour and 47 minutes in his State of the Union address last night. As you might imagine, he praised his own tariff strategy. He said the U.S. economy has never done as well as it is right now. Let's get more from Young Yu Ma, Chief Investment Strategist at PNC Asset Management Group. Thanks very much indeed for joining us.
Thanks, Andrew. Great to be here.
There was lots of rhetoric from Mr. Trump. Politicians, of course, like to tout their own achievements. They all do. But did anything jump out for you with this State of the Union speech?
Well, I think the topic that is most important to Americans right now is one of affordability. And that, of course, relates to inflation, which for years has been elevated now and is causing a lot of strain in the economy, especially among consumers on the lower end of the socioeconomic spectrum. The president did talk about that, of course, but it is something that it just takes time. And we see the inflation numbers perhaps still looking a bit stickier than we would hope to see them. We do believe they'll come down more by year end, but we do think that topic of affordability that the president did touch on is a big one in terms of the impact on the everyday U.S. consumer.
And I mean, the tariffs are inflationary. U.S. consumers pay, according to one take, 90% of the burden ultimately. Has Mr. Trump managed to disconnect that, though, in the mind of voters, tariffs and inflation?
Well, you know, I think actually probably the average American doesn't feel as much of that impact from tariffs. I don't know that I've seen different estimates. I have seen 90 as the upper end, but also you see some estimates that are much lower than that in terms of tariff pass-through. I don't think that's actually the big topic right now. I think most economists and consumers as well probably feel that the tariff impact has been less than what was originally feared in the economy and for markets as well. I don't think that's actually the big story now. I do think there's perhaps some uncertainty as the president does try to reconstitute the tariff regime that he wants to put back in place. I think that does create some uncertainty both for the economy and for the stock market here. I think that's a medium-term issue, not a long-term issue. It's going to take months to work through, not multiple quarters or maybe a couple quarters, but by year end there should be more clarity. So I don't think that's actually the biggest issue right now. I do think it's more one of affordability, one of jobs, job growth, which has been pretty muted here in the U.S. And I think that's primarily what the voters care about here.
So the current tariffs that he's put on are based on a supposed balance of payments problem for America. You think, though, he'll have to reach for other tools, though, apparently, because these will expire in 150 days?
That's right. Well, without congressional action, those would expire in 150 days. But there are many avenues for the administration to put on tariffs. There's Section 301. There's unfair trade practices. There's some. Those other avenues require more of a process. There's typically an investigation that goes along with them, so they take more time. And usually, in the past, those other acts or sections to enact tariffs have been country by country. And so that's something that, as we know from the previous tariff regime, those investigations can be drawn out, or that process can be one that's drawn out. So I think that's what the market's more concerned about, just the drawn out process here. It's probably reasonably well accepted, I think, that the tariff regime without the IEEPA tariffs is probably going to be a lower overall rate than the tariff regime through these other avenues to put tariffs on different countries or different sectors that the president might look to do. So I think, on net, I actually think if we're just looking at the actual tariff level, we're probably looking at one that comes in lower than had been previously the case.
Yeah, apparently I saw one story yesterday suggesting that China will face a lower tariff here on the current regime.
Oh, that's correct, as things stand now, because a lot of China's tariffs were based on those IEEPA, the International Emergency Economic Powers Act that the Supreme Court struck down. And so even this 15% global tariff does give China some relief here. But of course, the president already has investigations into unfair trade practices with China. So there's a lot that's in the mix. I think if I were to kind of summarize what's going on with that picture, there's a lot in the mix. There's more to come. It creates some uncertainty both for businesses and consumers as well. But again, I don't think that's actually the main story in the economy or the markets right now. I think that's something that casts a bit of uncertainty, but one that we can and have worked through in the past. And the markets and consumers are probably braced for that at this point.
Now, the fourth quarter GDP for the United States came in, it was a slowdown from the pretty torrid pace of 2025. But some analysts are saying if you dig into the numbers, the economy is doing pretty well overall in terms of growth.
Yeah, absolutely. I think the growth here in the U.S. is quite strong. Now, the swing factor, of course, is capital expenditures. Business capital expenditures, the hyperscalers, the data centers, the AI investment that's taking place. A lot of times it's talked about how consumer spending is such an important part of GDP growth, which being around 70% of growth, it is an important part of it. But oftentimes the swing factor is business spending, because business spending can either ramp up a lot or can pull back a lot. In this case, business spending and capital expenditures are really ramping up, and we think that's going to continue and something that continues to support growth this year.
And apparently a lot of that fourth quarter weakness was the government shutdown.
Some of that was. It did pull off. That's right. That did trim some of those growth numbers. So some of that will come back. Maybe not all of it in subsequent numbers, but it is something where we see the growth profile in the U.S. is still one that's quite healthy here. The job profile is different, and that's what consumers and are more concerned about, that jobs picture.
Sorry, just very tight. We're very tight. Jobs numbers are showing signs of weakness.
Well, they're stable, but there's very low hiring. And the hiring level is at recessionary levels. Of course, we're not in a recession, but if you just were to look at where hiring is by businesses, that looks like numbers that would be associated with a recession. So there are two very different job markets. For people that are in stable jobs and businesses, it seems like it's a very healthy and stable job market. But for those who are looking for jobs, it's a very challenging, almost recessionary-like job market. So I think that's where the disconnect is. And that softness, of course, there are concerns that softness in hiring could spread to increased layoffs, of course, AI disruption, perhaps accelerating in the coming quarters or years. So there's an underlying level of angst in the economy just relating to the labor market right now that's probably holding consumers back a bit.
Thank you very much. We just spoke to Young-Young Ma, Chief Investment Strategist at PNC Asset Management Group. Yesterday on Market Call, we were joined by Ernest Wong of Baskin Wealth, North American large caps for the topic. He likes Netflix, Domino's Pizza, and Live Nation. Today on the show, it's Darren Sissons of Campbell Lee and Ross. He's taking your questions on global and technology stocks. Up next, Thomson Reuters bounced back yesterday, but that stock, like other big software providers and data providers, has been sliding. We are going to hear from the CEO of Thomson Reuters after this. Shares in Thomson Reuters, like other data providers, have been under severe pressure over the past year because people are speculating that AI will carve into their business. The stock did rally yesterday after the company said it has reached 1 million professional users of its CoCounsel product. This uses artificial intelligence to help lawyers in particular. It also said it's working with Anthropic's Claude AI model. Let's get now to Steve Hasker, CEO and President of Thomson Reuters. Thanks very much indeed for joining us.
Hi, Andrew. Thanks for having me.
Tell us about this CoCounsel product. Now, just clarify for me, this was not developed, or was it in conjunction with Anthropic?
No, it was developed a number of years ago, Andrew. What we've done is we've created an AI platform for fiduciary professionals. So, as you said, lawyers, tax and accounting professionals, auditors. Essentially, we developed it a couple of years ago, and we've developed it in such a way that it is model agnostic. So, in other words, we can take the very best enterprise focused foundation model and swap that in. Now, at the moment, in our view, based on our testing, that's Anthropic's Claude suite of models. We have, though, developed our own model called Thomson, which is starting to outperform many of the models specifically for legal. And so it wasn't developed with Anthropic or Claude, but certainly we think their enterprise models are the best at the moment, but we've created some flexibility as we go forward.
I asked that because, of course, the investors were alarmed to hear about Anthropic developing plugins for Claude that could work specifically with lawyers. You have said that where the AI is the biggest change for the legal profession, really, since in the modern era. Tell us why. How will it be so important?
Yeah, I mean, the legal profession, sort of in its current form, I think is probably 3 to 350 years old.
Okay.
You know, it was sort of started in the tea houses in the city of London all those centuries ago, and it sort of fundamentally hasn't changed all that much. Certainly, word processing technology and e-discovery and other things have made some differences, but in our view, this will enable lawyers to be this being AI, will enable lawyers to be very, very significantly more productive. And I think what investors missed with the sort of Anthropic announcements and some of the moves of the foundation models is, at Thomson Reuters, we serve fiduciary professionals. And I think we have to distinguish, and investors, you know, I don't think have done this yet, between sort of knowledge workers, so that's general office workers at one level, professionals, so whether that's salespeople, communications, marketing, architects, whatever it might be, from fiduciaries. Fiduciaries, being lawyers, tax, accounting, audit, and the like, have to be right. I mean, the consequences of being wrong are very, very severe for fiduciaries. And what we do is we combine a model like Claude with, I think most importantly, our content. And we've got centuries of curated, highly specialized, very accurate content with deep domain experts, thousands of them, who train our agents. And what it does is it produces results that are fiduciary grade versus results that may be 95% right, which is not acceptable to these fiduciary professionals.
Yeah, I mean, that's the big thing, isn't it? It's got to be right. Although your stock is down by half in the past year. I mean, the market, that's a lot of bright people have been selling the stock. Are they completely wrong?
I think they are. I mean, I think they've missed this point about the quality and the importance of content and expertise to train these agents in this environment. We think we're the only player who can do that effectively and meet or exceed the needs of these fiduciaries. And so we think the investors have missed it, certainly over the last 6 or 7 months, and particularly over the last few weeks.
I have to ask you, and I don't think I'm going to get an answer. The Thomson family of Canada hold a big stake in Thomson Reuters. They have lost tens of billions on paper here. Have you talked to any members of the family?
Yeah, we're in close contact with the family. I mean, bear in mind, in the prior 6 years, the stock rose from $65 up over $200. So net, it's been a positive trajectory over time, and we have every intention of arresting the recent decline and getting back to those levels, and that's what we're laser focused on doing.
You've been on something of a PR campaign this week, or at least you're out there telling the street and the media, hey, we're fighting back here, and this threat is exaggerated, in your view.
It certainly is, and while we don't like to see this sort of pressure on the stock price, the business continues to perform, and as a team, we are laser focused on getting back to where we think we need to be and deserve to be.
You have this hoard of legal data, and as you say, it goes back centuries. You ingest tens of millions of legal documents every year. So is that proprietary, or can other people get at it?
No, it's proprietary. I mean, essentially what we do is we take many different sources, including court records and all of the sort of case law in jurisdictions across the world. We ingest that, but most importantly, our attorney editors, and we have 2,700 of them on staff, spend all day, every day interpreting those findings, dissenting opinions, figuring out which cases are relevant precedent, which aren't. And then in addition to that, we have many hundreds of practical law editors who are creating the best version of a particular draft, the best clause, the most specific IP for legal practice areas. So sort of that which is publicly available is a starting point, and it's an important starting point, but it really is the value add that our talented staff members add. That's what makes the difference, and that's what delivers the accuracy and the depth of expertise.
You do have competition coming at you, though. LexisNexis, your arch rival, teamed up with a legal startup called Harvey. I know you've said there are frothy valuations in these AI spaces, but you do have competition sniffing around.
Well, we've always had, I think we've always had, formidable competitors that we respect, and we've been able to invest appropriately and outrun them. And so we're, not arrogant about it. This is a moment of disruption, but we're certainly confident in our starting point and the plans we have going forward.
What do you think, broadly, will society be able to get away with fewer lawyers in the future?
Well, the first thing I think is that this sort of tech disruption will be no different than prior, whether that was the sort of steam engine, the combustion engine, factory automation, the internet, cloud, mobile, social. All of these things have created a spike in standards of living, improvements in standard of living, and a spike in legal activity and demand for high-end legal services. So I think the sort of broader addressable market for law firms, for general counsel's offices, goes up, not down. I think the question, which is as yet unanswered, is how much of that demand will be met by the technology, and we're the largest provider of that technology in the world today, and how much will be met with trained lawyers. And I don't think anyone knows that yet. It's too early to tell.
Thank you very much for joining us, Steve. Really appreciate it. Steve Hasker, CEO and President of Thomson Reuters. Let's check in very quickly on the equity markets. We have seen the TSX. Okay, we'll do that after the break. And we're going to drill into those Loblaw numbers. Welcome to the second hour of The Open. Here are the big stories we're bringing you from our newsroom. We've seen some selling in Loblaw today. Fourth quarter revenue at the gigantic retailer missed estimates. Profit was slightly above expectations. Food retail and pharmacy same-store sales did increase. The results come as high inflation and a rising cost of living have forced consumers to try to tighten household budgets. U.S. Trade Representative Jameson Greer says the tariff rate for some countries will go up to 15% or higher from the newly imposed 10% rate. Greer did not mention any specific trading partners or provide any other details. However, he said the new tariffs will be in line with the levies that were previously in place. This comes after the U.S. Supreme Court struck down President Trump's tariffs last week, or many of them. Shares in HSBC, the banking giant, trading higher today. The company beat annual profit expectations, boosted by its wealth business and core Hong Kong franchise. The lender also expects to reach its cost savings target 6 months ahead of schedule, and it lifted its return on equity targets through 2028. TSX trading in record territory, breaching 34,000. Our market, as you can see, excluding dividends, up north of 35% in the past year. And let's have a quick look at the U.S. market as investors await the NVIDIA results later today after the market closes. We are seeing heavy trading as usual in NVIDIA. That stock up about $2 up, around 1%. Tesla advancing 2%. Micron, the storage company, up 4%. And just looking at any other significant movers, well, that's an interesting one. I'll try and bring you more on this. Mercado Libre, which is a Latin American version of Amazon, disappointing the street, down 10%. Spending weighing on profit margins. So investors kind of meh about those Loblaw numbers. The stock slipping. Let's get more from Garnet Anderson, Head of Portfolio Manager at Tacita Capital. Thanks for joining us.
Good morning.
You reckon this is an expensive stock, so any slip, it could be vulnerable?
Exactly. If you're just meeting target, I mean, by a penny, I don't think the market's going to get overly excited about that. You mentioned same-store sales. On the grocery side, up 1.5%, which is lower than what food inflation was. So that's not a great bell ringer. The pharmaceuticals, or the pharmacy aspect, and that doing well, I think that was very much a positive. We were just chatting about how the purchase of Shoppers Drug Mart a number of years ago is looking like a great step there. So when you take a look at a stock that's up at 26 times next year's earnings, which is interesting for something that's supposed to be a defensive stock.
Yeah,
it's kind of an interesting little oxymoron there.
It's
but
not such a high growth industry.
No, it's not. I mean, and when you're talking about revenue up and profit up, but so they came in a little bit light versus expectations. Year over year growth, okay, positive. You can see where they continue to stretch out and adjust to the economic cards that they've been dealt. So what is that? Muted population growth. The Canadian consumer is a little bit stretched. When you take a look at their big development plan for 2026, it's continue to go and complete the construction of their distribution centers. It's to go and target new stores, but geared more at a more cost-conscious consumer, and go out and refurbish stores with the eye of trying to drive up those same store sales, right? Because you take a look at how they're placing merchandise and how they're doing non-groceries, that's a decent part of their market. And that saw a little bit same-store sale growth up in the 2% range. So that was a little bit of a positive. So how they move those chess pieces around to try to maximize the assets, they're certainly paying attention. They announced their Google Gemini shoppers tool. Haven't seen it yet, but I'm sure it's wonderful. Again, a step in trying to maximize the efficiency of the stores using AI, because they're competing against the Walmarts and so forth that are certainly going in there hard and heavy on those investments. So Loblaws, I think, had to step up to the plate. And naturally, when you've got a big capital distribution plan coming up, the market will take a step back. As a share of its total assets, it's 2%, give or take.
For
2026, this big spending plan.
Yeah.
2%, I don't think, is going to shock the market into retreat sort of thing. How they go and fund it, and also if they did, not saying they will, but if they had to raise equity, good price to raise equity at. They certainly have debt capacity if need be. Their credit rating is fine at BBB+. So no concerns, but not surprised that it stepped back today. It remains a hold in our portfolio, not something we're necessarily looking at adding to. We would love to add more to the defenses in the portfolio, but at these valuation levels, we're not sure how much defense we will get for the first 10 or 20% drawdown whenever the next bear market is.
I wonder if you open new stores, is there a risk of cannibalization? Because they've got so many stores already.
Well, they certainly do. Having said that, they've been doing this for a long time.
They know what they're
and they would surely understand. They're using something more than just the census data that we would have access to, and where they were putting down those new stores and the type of new stores, and like their TNT. There was a lot a lot of news about that last week as an analyst came out with a good profile on that.
CIBC did a mega report.
Right, I thought they did a great job there. So where are you going to put one of those stores? Well, you're figuring out the demographics and the growth demographics, the income characteristics of those households, and can it support a store or not?
Yeah, sorry.
So they're disciplined.
Yeah, TNT, I was hoping to do something. I tried to do something on commodities tomorrow. I glanced at the report because that's their Asian supermarkets, and they're expanding those into America as well.
Well, they've got, from understand, they have 2 down there right now out on the West Coast, and they've done very well. They've benchmarked against other local competitors, and so the goal is, or that report spoke to the ability to, you take a look at the Asian or the Eastern Asian population in the States, how many stores it could support, take away the competitive stores that are already there, what's that opportunity set, and what's a big number. Now, that will be a longish build out. And before we ring the bell on that, I always kind of go, retailer going into the U.S. Let's just see how they march it out. We watched, Dollarama, step it down in the States. You just have to go at a measured pace.
What about National Bank? Are you interested in that stock?
Yes, we've got it in our portfolio. It has done well. It trailed, and then it hurried up and caught up and did very well. And then the past couple of months has kind of settled back a little bit. Again, when you take a look at not just National, you take a look at the other banks, they are trading, call it about a 25% premium on their valuation metrics compared to their historical norms. So again, not cheap, but are they firing on all cylinders? You take a look at National, which again, when I checked this morning, it was up nicely. From their loan book, their commercial and their personal banking, that was up over the year. Their loan loss provisions came in a little bit, which is nice to see compared to where we were a year ago. Everybody was running around going, oh my goodness, what's the bad loans? Provisions have to be on the bad loans. But no, those have kind of come back as the economy's proven a little bit resilient. The wealth management arm, if wealth management divisions aren't doing well with the bull market that we're in, something's wrong. So they pumped out the numbers there. And capital markets, I thought capital markets for National was a little bit lighter than I would have thought, but not dramatically. So I'm not surprised to see. And they still have the Canadian Western Bank acquisition coming in that they continue to digest. They seem to be marking progress quite well, and the market remains excited about that opportunity set.
Let me just very briefly touch on, I didn't know Dollarama tried going into the States. They did go into Latin America.
Yes, they went into Latin America.
Yeah,
yes.
I don't know if they've tried the States yet, but I'm sure they're thinking about it.
Yes.
Yeah, oh yeah. Garnet, thank you very much indeed.
Thank you.
Garnet Anderson, Head of Portfolio Manager at Tacita Capital. Coming up, U.S. President Donald Trump praising the effect of his tariffs in last night's State of the Union address. It lasted a mere hour and 47 minutes. We'll have more after the break. U.S. President Donald Trump, in his State of the Union address, said the U.S. economy has never done better. But of course, that comes after the U.S. Supreme Court's decision to overturn some of his global import levies. Let's find out what the impact here on the broader economy will be, including here at home. Preston Caldwell joins us now, Chief U.S. Economist at Morningstar. Preston, thank you very much for joining us. Was there anything, President Trump, as politicians do, sang his own praises. Did anything jump out for you concretely, economically, in the State of the Union address?
No, it was a fairly backwards-looking speech making the case for the administration's performance thus far. So I didn't glean much in the way of what's to come for tariffs. I think we're going to have to wait a matter of weeks and even months to see how the tariff situation shakes out, because really what's key is these Section 301 tariffs that are going to come into place for various countries after the 150 days of Section 122 tariffs expire. And those Section 301 investigations take quite a bit of time. If you think back to the 2018 to 2019 period in the first Trump administration, when those were levied on China, that was a multi-month prolonged process to get those tariffs in place. And so it's not like what we saw with the IEEPA tariffs that were just struck down, where those could be put in place with the stroke of a pen. There's massive amounts of paperwork and documentation and argumentation that has to take place. So we'll still be waiting a while to see what the longer term tariff regime looks like for the rest of the Trump administration.
tariffs have been a money machine for the U.S. government, revenue well over $100 billion US. I know some people have likened them to a sales tax, which would be politically anathema, a federal sales tax. So broadly, have the tariffs been a win for the United States?
So in our analysis, tariffs are a significant efficiency drag on the economy in the long run. Now, what I will say is that many of the ill effects of the tariffs have not fallen into place for the U.S. yet, because very little of the tariff costs have been passed on to final consumers. And therefore, you've had relatively little in the way of altered economic decision making because of the tariffs, because the final consumers aren't paying those costs yet. And that was for a variety of reasons. In 2025, I think companies were still selling their pre-tariff inventory, so they didn't feel they had to raise prices yet. And also they were waiting for the Supreme Court decision to kind of bail them out. But, now with tariffs lasting at least, high tariffs lasting at least for another 150 days, and after, what happens with the Section 301 investigations, perhaps quite a bit longer, companies may be still looking to pass on quite a bit more of that tariff cost to consumers. And once we see that, then the negative economic consequences will, I think, start to manifest in a larger magnitude.
In the sense that goods that are more efficiently produced outside the United States are costing people more.
Precisely, yeah. And you mentioned the revenue benefits from tariffs, and that is a factor. That's a few tenths of a percentage point of GDP, so nothing to sneeze at. But we think of tariffs as being a relatively inefficient way to tax, because they're a high tax rate applied to a narrow tax base. So all taxes have some efficiency consequences, but tariffs are generally thought to be particularly large.
And of course, rebuilding America's manufacturing base, if that's possible, that's a thing that's going to take decades. I mean, these are such slow-moving events.
That's certainly something we haven't seen yet at all. Manufacturing employment, manufacturing output has been, flat to down over the past a couple of years. So there's been no impetus to the U.S. manufacturing sector from tariffs so far. And that ties in with what I said earlier about, this not really hitting consumer prices yet. So consumers, heretofore haven't had reason to switch from imported to domestic goods because they're not getting a price signal yet.
And apparently in the U.S., there's been a lack of business investment, relatively speaking. I mean, that's a problem plaguing us in Canada as well.
What's interesting right now is, as of the fourth quarter 2025 in the U.S., private fixed investment would have been in negative territory, negative growth territory, if not for the impact of AI. So AI is the single driver that's propping up positive growth in fixed asset investment for the U.S. Everything else is still feeling the effects of high interest rates, for one. There's a few other factors that are at play. But yes, indeed, private fixed investment is still in a somewhat vulnerable state, if not for this boom in AI that we're seeing.
Yes.
And who knows how much longer that boom will last.
Yeah, it's interesting. I've read, we're out of time, but we'd love to have you back maybe to discuss the sustainability of the AI investment curve, et cetera. Thank you very much, Preston, for joining us.
Sounds great. Thank you, Andrew.
Preston Caldwell, Chief U.S. Economist at Morningstar. Coming up, Bruce Flatt, the CEO of Brookfield Corporation, discussed whether trouble in the private credit market will disrupt the broader stock market. That's next. Concerns are growing in the private credit market. The the well-publicized troubles of Blue Owl, major player, have raised concerns here. And that unease has prompted some observers to draw parallels with the run-up to the great financial crisis in 07-08. However, in an interview with Bloomberg Television, Brookfield's CEO Bruce Flatt said today's environment is not a repeat of 2008.
Private credit's very small, and software loans are even smaller. And in a global situation, the credit markets are very, very large, and this is not a systemic issue. There's only really two things that can bring the world down from a systemic basis, and that's bank balance sheets, and they're in excellent shape, and real estate loans, and housing in the world, and it's in excellent shape. And the consumer is still able to pay all its mortgages. So neither of those are systemic issues. And so I think we just have to step back and think about it into perspective. There's always, with revolutions or evolutions that are going on, it's never a straight line. And we just have to, there will be ebbs and flows on the way to what's going to be an incredibly productive era that's coming with the new technologies that are being developed. And it's been going on for 30 years. It may be going faster today, but this is just a continued evolution of what's been going on.
But Bruce, so why do you think the market seems on edge, right? You're right. So is it because they're worried about AI being systemic? Is it just there's too much money out there? They don't understand private credit? Like, why is everyone so on edge?
Firstly, I just think the world is always thinks it's the worst time at the moment. And when you've been through these before, they're always the worst. But I can tell you there's been 15 worse ones in even my career. And therefore, I think we just need to step back, put it in perspective. This is not that big of a deal.
So this is not a rerun of 08, or in the run-up of a rerun?
It's definitely not of 08. Like, it's got nothing to do with 08. Now, will artificial intelligence affect some companies, and will some companies or loans to some companies be not pan out as they were expected, or multiples were paid too high for some businesses? Yes, that occurs in every cycle, and probably in 20 and 21. There were companies, we weren't doing it because we don't make software acquisitions or loans by and large, but there's always some of those things that come about. But this is not that big of a deal for the financial system. I think that's the most important thing, that the news gets wrapped up in small things that seem to be of the day.
People are fearful, right? And I can't point to what people are fearful about.
I think it's just change. People always are worried about change, and we're going through faster changes today than we've gone through before, and they keep change keeps getting more rapid all the time. And but I would go back and say, we've been building the backbone of the global economy for 40 years, and we do the exact same thing, except the type of things that we're building today are just different. Before it was water systems and pipelines and toll roads, and then it was telecom towers, and now it's data centers and AI factories, and it's just the backbone evolves, and I think people just get unsettled by that.
I mean, do you think what happened at Blue Owl signals something broader?
No. Look again. Just step back. It's a very small component. And therefore, I don't. Firstly, just to be very specific, I don't run Blue Owl, and we don't really make loans in software. So this is not our business. But if I step back just as a financial person, this is small relative to the global markets, and we shouldn't get too wrapped up in it.
Okay, I want to get back to infrastructure and some of the deals that you put together. But do you think the industry should reconsider, I guess, opening some of the private markets to retail investors, given all of the anxiousness out there?
So the first thing is, remember, all the money in the world is owned by retail investors. It sometimes, and who we've managed money for in alternatives before, is pension funds who manage money on behalf of individual investors, an insurance company who manage money on behalf of individual investors. And now what's happening is the world is just desegmenting that and going to open up 401ks or alternative accounts in a different way. And that's all it is. And what I would say is, and we've been very careful to make sure because we're building this business for the next 100 years, and very careful to not make mistakes along the way of getting to opening up retail. But everyone's learning what those structures mean and how to make them, and so I think it's just a learning process. And of course, there are some mishaps along the way, but it's not a big deal to the overall financial system.
So you've been very acquisitive, and again, you've laid out the vision pretty clearly, which is, we build for the longer term and we invest in the economy of tomorrow. Is there anything that you're missing now that you want, where you think the economy will change, that you need a piece of?
You never know what's coming. Like we coined 3 Ds, or somebody coined, might have been us, not sure, many years ago, and that was deglobalization, decarbonization, digitalization. And even in the 7 years since we've been talking about those 3 Ds, the nuance, we've slightly changed each one. Like digitalization was really about building for cloud, and today it's building for AI factories. And decarbonization was building clean power, and today it's about building any possible power we can build, because we need more power. And deglobalization was about building in the United States, and today it's about building in many different countries. And so I think there are nuances of change, and you never know what comes exactly tomorrow. But what I'd say is, what's happening today is we're laying the fundamental backbone of the next layer of infrastructure. And artificial intelligence and the infrastructure to drive artificial intelligence is really just the toll road or the pipeline or the water system of yesterday, and it's of today. And that's really what's going on today, and it's being laid by countries. And we're helping some of them do it. And it's being laid by the big technology businesses because they have the resources to be able to do it.
Bruce, there's so much private capital going into building these AI data centers right now. What if demand doesn't live up to expectations?
Well, firstly, anything that we're doing is contracted to a country or a company. So that's their risk. Because when we start these developments, they're contracted. So that's the first point, and that's the big difference from people. People reckon back to when they were laying fiber in the .com era, and those were, you laid fiber and you hoped a customer would come. Today, what we're doing is we're building AI data centers for countries and companies, and the countries are creditworthy. I hope so. And the companies are like countries. These are enormous companies, and really they come to us because we have the resources to be able to help them facilitate the build out of power, connectivity, data center buildings, and and wire them inside. And that's really why they come to us and some others like us. But this is an enormous build-out of the next layer of infrastructure in the world. And that's really all it is. And this time it's being led by the best of the world. And therefore the credit capacity is there. And in the private markets, there are no issues. In fact, the only issue is, can we build them? Like, we just can't build them fast enough, because the demand is so large. Now, your question was, will it pay off?
Yeah, or is there too much capacity? I mean,
there is not too much capacity. We can't build enough. Yeah. But the question is, will it be profitable for them? And I think it will be. And what we're seeing in our industrial businesses is being able to use artificial intelligence in very innovative ways to lead to productivity advances, I think, which will be probably the most productivity advances ever seen in a shortish period of time in the history of the world.
I mean, you're such a big player in this space. Would you ever spin off the unit? How do you see Brookfield changing in the next 5 years?
We've spun a lot of things off over the years. We sort of stopped doing that because people thought we had too many of them. We're reconsolidating a number of our businesses on the public side today, so probably not. And we've got the structure is actually pretty good today, and we're cleaning it up.
So how do you say, are you trying to morph into this investment-led insurer? And how, what kind of timeline are you looking for that?
So our main holding company up top, Brookfield Corporation, we really have three businesses. Our asset management business, which is separately traded, and then we have our insurance business and our investment business. And we're really just pushing the two of those together because we have $170 billion of capital in our investment business, which is freely available to help our insurance business either be way overcapitalized or to be able to grow. One of those two. And it's probably a combination of the two things. It's going to allow us to grow faster than anyone else because we have more capital than others. And secondly, it allows us to be way overcapitalized, which gives us much more flexibility than most similar groups when you have excess capital. So we can, instead of, like in the last 24 months, we haven't been putting a lot of money into credit. We've been investing in our equity strategies. We just hold lots of cash. And we've been investing in equity strategies similar to what Berkshire Hathaway did for years. And that's sort of the model that we've been tending towards.
So it makes you more flexible, I guess. Flexible and more profitable.
The number one thing in investing is to have flexibility and not be defined in what you have to do. And by having more capital and allowing your balance sheet to be flexible, it allows you to be creative, innovative, and to assist people achieve their goals. And so our whole goal over time has been to have as much capital and more capital than any other competitor we have so that we can do things that others can't. And it just allows us to help our clients, customers, institutional investors, counterparties, do things that others may not be able to do with them, and it doesn't always work that way, but it just helps you be better. And we happen, for 35 years, we've collected capital. Yeah. We've paid a small dividend. We've collected capital, and that allowed us to have a very large balance sheet. And sometimes people look at it and say it's overcapitalized, but the fact is there are times when excess capital is extremely valuable and allows us to have the confidence to do things that many others can't.
Bruce Flatt of Brookfield talking to our Bloomberg partners. I'm just looking at a 5-year chart here for Brookfield, total return of 123%, including dividends. The TSX, beating the TSX return of 116%. However, the stock has been a laggard lately. It's been giving up some of those gains. In fact, the latest numbers I have are for the past year, Brookfield's up only 12%, whereas the TSX is up total return 39%, and the TSX Financial Index is up 36% total return. So you can see that Brookfield has been lagging lately, those other two indices. Let's check out some other stocks we're out of time. National Bank surging to a record high. We'll have to get to that shortly. However, Hot Picks is coming up. We've got 3 global stocks for you. That's ahead on the open. Time for Hot Picks, and we are zeroing in on 3 global ideas. Our guest has Public Policy Holding Company as a top selection. He sees an attractive valuation for this US-based outfit, which is big in the lobbying business. We're joined by Fabian Renauer, Portfolio Manager at Canoe Financial. Thanks very much indeed for joining us, Fabian. PP.
Thanks for having me.
HC. So they make their money from lobbying in part?
Yeah. So very refreshingly, this company has nothing to do with AI. Certainly nice in today's environment. So yeah, it's a holding company that owns several leading lobbying firms and corporate communications companies. They're primarily focused on the US, as you mentioned. The way to think about them is they're essentially a consultant that helps their clients navigate the political landscape. And so politics is an area of major risk and opportunity for companies. So if you think of businesses like Google or Cigna or Meta, they want to go with a well-established provider that is reputable, has been around for a long time, and that's essentially PPHC. They serve about half of the Fortune 100, about a quarter of the Fortune 500, so really as good of a client base as you could ask for. And what we like about the business is that it's an industry that will never go out of fashion. I mean, it's been around for a very long time. It will always be around. PPHC are building a winning team. The industry is still very fragmented, so there's a lot of room for them to continue to grow.
And
political uncertainty actually benefits them, which is also very nice in today's environment. We have a lot more uncertainty politically than we would probably like. And the attractive part is that the company trades at a very attractive valuation for such a high-quality consultant, about a 7 to 8% free cash flow yield. The reason for that is just it's a small business, it's undiscovered. They only recently dual listed under the NASDAQ. That's the opportunity. But we think it's just going to be a matter of time until more investors take note of the success that PPHC is having.
Right, and so they just went public, not a huge deal. They raised only about $50 million US.
Yeah, so they were public in the UK since 2021 on the UK small cap exchange, which was really not ideal. I mean, they're a US company in a very American industry, so it was very, very undercovered in the UK. And they finally got enough scale that they could do a list in the US on the NASDAQ. And so really, we think that's going to elevate the profile of the company. And the share price has just not kept up with the success that they've been having. They've grown leaps and bounds, and it's a great business.
Equifax, the big global credit bureau, and also important, I think, for new employers that they're trying to verify the history of applicants.
Yeah, correct. So they're one of 3 global credit bureaus. The way to think about a credit bureau is if you or me apply for a mortgage or a credit card or an auto loan, the lender has to get the data somewhere to verify our income. And so essentially, they go to the credit bureaus and they get a credit report, and that's what they use for underwriting. And as you mentioned, they also have an income and employment verification business. It's called the Work Number. And so if a underwriter or a government agency wants to verify a consumer's current employment status, they just ping the Equifax database. And so what Equifax's businesses share in common is that they are powered by proprietary data, right? So on the credit bureau side, there's only 3 players, Equifax, Experian, and TransUnion. They're the only ones that have that data at scale. On the verification side, it's actually even more concentrated. So even Experian and TransUnion have a very, very hard time getting that data. They're trying, but Equifax is by and far the number one. Not quite a monopoly, but also not a million miles away from it. And so what we like about that business is the verification business has a very long runway to grow. A lot of verification today is still done manually, just by using the phone and calling up the previous employer or the current employer. Pinging the Equifax database is so much more efficient. The return on investment is very logical. And on the credit bureau side, they have a very big mortgage business. And so as you might imagine, the recent rise in U.S. Mortgage rates has really, really hurt that business. So they're vastly under-earning today. It might take some time, but when the day comes that U.S. mortgage rates do come back down, there is a lot of revenue that will flow back into that business that you're really not paying for today at a close to 5% free cash flow yield.
The final idea, Deutsche Börse. Now, they're a stock market, a stock exchange company, and there have been fears that AI will hollow out some of the lucrative data businesses of that industry.
Yeah, so what's interesting there is, as you mentioned, they're a leading exchange group in Europe. They're actually less a stock exchange than a derivatives exchange and clearinghouse and settlement venue. So a lot of really, really critical market infrastructure that usually concentrates around a single market leader. So in this industry, there are natural network effects. Regulators also don't really like new entrants because this market infrastructure is so critical, right? And so if you want to trade in European interest rate futures, for example, there are really just 2 providers that you can use, for example, Deutsche Börse and Intercontinental Exchange. So incredible market position, and the data you mentioned is proprietary data that comes out of their exchanges. So there is nobody else that can sell that data other than them. So if you're a company that collects historical data that's publicly available, yes, there's more AI risk, but that's not what Deutsche Börse does. They just resell their data, which is a byproduct of their exchange business. And so why we like that business is, number one, the assets are incredibly durable. They're so difficult to displace. And they have a number of secular growth drivers on top of that. So for example, one of their businesses is the European Energy Exchange Group, which benefits from Europe's shift towards renewable energy. It requires a lot more hedging because you essentially have a more volatile energy price environment. And the energy exchange also benefits from derivatives being increasingly cleared and traded over exchanges rather than over the counter, which is what regulators are actively encouraging to mitigate risk in the market. The second part of the business that is really attractive is that they are in this enviable position of benefiting from a rise of debt outstanding in Europe. So the more debt companies and governments in Europe have, the more revenue Deutsche Börse makes because they monetize that whole stack. So that debt just goes one way, which is upwards. They have a number of other growth drivers as well, but really to summarize it, it's incredible assets that can't be replicated, good long-term growth, and it trades at about a 6% free cash flow yield just because there's a lot of uncertainty today, as you mentioned. People think about this as just a data business, for example, and that's just the wrong way to characterize it.
We'll have to leave it there. Thank you very much indeed for joining us.
Thank you so much. Really appreciate it.
Fabian Renauer of Canoe Financial. We've got lots more coming up. Canadians have just 5 days left to contribute to their RSP for 2025. We are going to talk to financial planning expert Julie Severus after this. Canadians have 5 days left to contribute to their RSP for 2025 to help cut taxes owing for last year. Our guest says every dollar you contribute to an RSP goes toward paying for yourself in retirement rather than paying Canada Revenue Agency. We're joined by Julie Severus, Head of Wealth Planning at Manulife Wealth. Thank you for joining us.
Thanks for having me.
So March 1st is a Sunday, so you have until March 2nd. You can contribute still on Monday.
Exactly. You can contribute on Monday, and that's sort of the first 60 days of 2026 that allows you to make a contribution that you can use towards your 2025 tax return. And so your 2025 contribution limit is going to be based on 18% of your 2024 earned income up to a maximum of $32,490. But don't worry, you don't need to calculate that number yourself. CRA provides that for you on your notice of assessment. So when you did your tax return for 2024, they would have sent you back a notice of assessment that tells you what your contribution limit for 2025 is. And that is the contribution limit that you're going to be looking at, generally speaking, when you're making these contributions for the first 60 days of 2026. Now, you can use that deduction for your 2025 return, but if you determine that maybe you have a year up ahead where you're expecting more income, you can carry that deduction forward. You don't have to take it this year. Really, you want to maximize it. So we have a graduated tax system. The more income you earn, the higher the tax rate that you're going to pay on that. So if you have a year where you think you have more income coming in the future, you may not want it this year. You can push it forward to another year and take it when it makes the most sense for you.
Of course, you don't get that 18% if you're in a pension plan or a group RSP, for example.
Exactly. When you contribute to a registered pension plan through your employer, you're going to get on your T4 what is called a pension adjustment. And that is going to reduce your RSP contribution room for the contributions that you and your employer made to that registered pension plan. And so that'll already be factored in when you get your contribution limit. But what you have to be careful of too is the difference between a registered pension plan, which is borrowing from next year's contribution room, and a group RSP, which is going to be in the current year. And it's not only your contributions that are going to count, but also any contributions that your employer makes on your behalf. So it's quite common if you have a group RSP that you're putting money in and maybe your employer is making a match. So make sure that you're not overlooking the money that your employer has put in on your behalf as well, because that counts against your contribution room as well.
But doesn't CRA calculate that for you, including the employer contribution?
So you need to track that. So let's say you had the full amount this year. Let's say you had the $32,490. Any money that you put in this year as well as any money that your employer puts in this year, is going to go against that contribution room available.
Right. I can't quite follow that. I'm really sorry. So CRA doesn't take into account then the money that your employer put in?
So you need to, that's going to be on your tax receipts that you're going to get.
Oh, okay.
So you need to make sure that you're also considering, if you're thinking, I have this much contribution room available to me, it's not just what you put into that, it's also what your employer puts into that that's going to count against that contribution room.
You sometimes do hear criticism of RSPs. People say, well, I'll have too much money in my RSP. Good complaint. But that'll push me into a high tax bracket.
So the magic of RSPs and the idea is that you're putting the money in your high income earning years and you're getting a nice deduction for that. And then you take out the money in retirement when possibly your tax rate is lower because your income is lower in retirement. So sometimes you do hear, well, what if my tax rate is higher in retirement? Well, that means your income is higher in retirement. Which is not necessarily a bad problem to have. I mean, one might say if you need to pay income tax, that means you have income, which is not necessarily a bad thing. But, you really, the RSPs still make sense for your retirement savings. We have lots of other registered plans available, TFSAs and that sort of thing. But when we're talking about retirement savings, there is such a great place for RSPs and the tax benefits available to them. So don't overlook them for retirement savings.
The TFSA, of course, is more flexible.
Absolutely. And that's where the TFSA has so many purposes, because you can put money in. The RRSP, generally speaking, is, for your retirement savings. That's where, it's most suitable. And of course, we have things like the home buyer's plan that you can use in RSPs and lifelong learning. And that's the other thing that you want to keep in mind for tax season as well here. If you have participated in that home buyer's plan previously, so that's where if you're a first-time home buyer, you can take out some money to put towards the purchase of a new home, or the lifelong learning program where you take out money to attend post-secondary school. If you have participated in those programs, you have to remember that you have to be paying yourself back. And so as you're doing your taxes for 2025, if you have those payments to make, you need to make sure you factor those in, because if you do not make those payments, then it's going to be included in your income for the year and you're going to need to pay tax on that money. So make sure you're following any payments that need to be made under those programs as well.
Paying the money back into your RSP.
Exactly. And CRA will tell you what that is. And so your best source of information is going to be your notice of assessment that you get from Canada Revenue Agency. You can also go online. There's My Account on CRA's website that you can go. So just make sure that you are familiar with these numbers, because you do not want to over-contribute, because there is a penalty of 1% per month for the amount that you've over-contributed. So if you do find yourself in a situation where you have over-contributed, you want to get that money out as soon as possible to stop those penalties.
1% a month. That's Tony Soprano country.
Of the over-contribution.
Yes, okay, yeah.
So it's really up to you. The onus is on you as the taxpayer to be tracking the contribution room that you have available and how much you have contributed.
Just finally, are there any mistakes that people make when it comes to the RSP contribution deadline, for example?
Well, making sure that you get it in on time. So, try not to leave it as long as possible. As you mentioned, we have a few days left, but I highly recommend you get ahead of that.
Because the system will be busy probably.
Yeah, you have all those last minute people waiting. So try and get ahead of it. And again, just be aware of your contribution room. So this includes contributions you made to spousal RSPs, contributions that you and your employer have made to those group RSPs, and get yourself in order and make sure that you file on time as well.
And I guess some people think, well, I'll just get the money in and decide what to do about it later. But the risk is you just forget.
Well, and that's okay, but you have the opportunity cost of sitting in cash potentially, right? So, but getting it into the RSP from tax purposes is what you need. How you want to invest it is going to be next.
It's funny, yes. So 60 days, it's a favorite among Canadians, although a lot of people can't afford, apparently, to build up an RSP.
And every little bit matters.
Yeah,
so, maybe it's contributing each month. Get something, sort of out of sight, out of mind. Pay yourself first. Get it right off your paycheck.
I've always found that works for me.
Yes.
If I get my hands on the money, it tends to.
You're not alone.
Yeah. Julie, thank you very much indeed.
Thank you.
Julie Sabaras, who is head of wealth planning at Manulife Wealth. Just a reminder, Know Your Options is back and it's on today. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. And send us your questions at knowyouroptions@bnnbloomberg.com. Thanks very much indeed for watching the Open. Morning Markets is up next.